COMEX registered silver inventory is now sitting around 103 to 110 million ounces. March open interest is sitting at roughly 103,000 contracts. That's about 515 million ounces of paper silver tied to a vault system holding barely 1/5 of that in registered metal. Now, before anyone panics, most of that 515 million ounces will roll or cash settle. It always does. Only a small fraction ever stands for delivery. But the issue would be, if even 10 to 20% of March contracts demanded physical, the stress would be immediate. If 25% stood, mathematically, the shorts are cornered. It's basically the disparity between inventory versus obligation. The problem is that inventory, aka physical silver, isn't growing. COMEX vaults are down again week to date, registered around 103.5 million ounces and falling. Total vault holdings around 394 million ounces, down roughly 2.75% on the week. Meanwhile, in China, the drain continues. SHFE plus SGE vaults combined are sitting near 887 tons. That's roughly 28.5 million ounces. Since 2020, China has drained around 6,600 tons from stockpiles. That's close to a 90% reduction in 6 years. If that pace continues, vault coverage tightens very quickly. On top of this, silver lease rates in London are pushing 6%. In normal conditions, that number would be 0. 6% is not normal, but these aren't normal times. And at the same time, COMEX open interest has dropped to the lowest levels since 2018. That's not collapsing demand. That's a flushing of leverage. Higher margin requirements forced weak hands out. Shorts covered. Some flipped long. It was a paper reset. Price resets, leverage resets, but physical market shortage doesn't disappear. London free float estimates dropped almost 9% week over week to roughly 200 million ounces. BlackRock's SSLN holdings are down 25% year to date. SLV is down about 1.2%. What it means is that capital is shifting inside the structure. So while the paper price swings violently, the physical side keeps tightening. Now zoom out. If you look at silver divided by USM2 money supply and draw a regression back to the mid-1980s, the recent rally actually breached the historical range. This pullback on a long-term chart looks like a retest of that broken range, not like a collapse. Price hasn't even taken out the 2011 extreme yet. Perspective matters. Technically, the recent move looks like an ABC correction, where wave C failed to extend meaningfully beyond 50% of wave A. When bears run out of momentum like that, reversals can be sharp. There's also a possible inverse head and shoulder structure forming. A decisive move back above $80 strengthens that case. Above $90 to $95 is the real resistance zone. That's heavy. Clear $95 and the path toward $100 to $110 opens up quickly. Some believe $120 gets taken again. Others are talking $180. Those are projections based on structural tightening and historical analogs to 2011. There's also a seasonal angle, consolidation for 1 to 2 weeks, possible bounce next week, then volatility again during the Chinese New Year holiday window. End of February into March becomes critical as delivery decisions lock in. But here's the bigger debate. Is this a squeeze on physical silver? It can be, but only if paper holders actually demand metal. If they roll, nothing breaks. If they stand in size, credibility is tested. That's why people are calling this a critical phase. Now we also need balance. The platinum to silver ratio is sitting about 1.65 standard deviations below its long-term trend, historically stretched. On a pure statistical reversion basis, platinum actually offers better risk-reward right here. A mean reversion could imply 167% outperformance versus silver. An overshoot could imply even more. And if we slide into a deeper global recession, silver could get hit hard while gold holds up better on safe haven demand. This isn't one-way traffic. Geopolitics adds fuel. Iran tensions rising, oil sanctions back in play, risk premium creeping into metals again. China's solar build-out continues to structurally absorb supply. That's arguably the real driver behind the move through $30 and the longer-term case toward $100 plus. Silver is just a tiny market. Right now, leverage has been flushed. Lease rates are elevated, Vault inventories are thin relative to paper exposure, and silver is no longer overbought on momentum metrics. That's why some believe we put in at least a short-term low. But if you throw away the charts entirely and assume shortage, dollar instability, or COMEX stress, then traditional resistance levels won't matter anyway. That's the fork in the road. Scenario 1. Consolidation completes, $80 breaks, $95 clears, and we grind toward $100 to $120 by summer 2026, possibly echoing the 2011 structure. Scenario 2. Recession bites harder than expected, industrial demand softens, and silver gets hit again before any structural breakout. The extreme long-term calls, $180, $500, even $750, assume a monetary repricing event and sustain physical scramble between industry, tech, defense, and energy. That's a regime shift call, not a short-term trade. If delivery demand stays small, nothing breaks. If delivery demand spikes, credibility of the paper market gets tested. March will tell us whether this was just a paper flush or the beginning of something much tighter underneath.